Welcome to the weekly market update. I am the Options Overlord, and this is the market week ending July 24. Read through an options lens. Educate, discipline, execute. 3 numbers on your screen. The S&P closed at 7,411. The Q's at 684 and the VIX at 18.58. What those numbers mean for options sellers is the next 8 minutes. Let us get to work. First, the ground rules. Every week, no exceptions. This is educational content only. It is not personalized financial advice, and nothing here is a recommendation or endorsement of any security. Options involve substantial risk of loss. Past results do not guarantee future returns, and options have tax implications, so consult a tax professional. I am not a licensed financial advisor. Before you act on anything, consult a qualified professional who knows your situation. By watching, you accept these terms. Good. Now let us score last week. Accountability first. Every week, this channel sets a rule for the week ahead, and every week we grade it in public. No exceptions, no quiet deletions. Last week's rule: watch the VIX 20 as narrow breadth meets mega cap earnings. Watch level, VIX 20. The verdict held. The VIX never closed above 20. It finished the week at 18.58, lower than where it started, and breadth moved the opposite way to the risk the rule was guarding against. 62.4% of S&P names now sit above their 50-day average, up from 43.9%. The level held, and the narrow participation did not develop. 1 for 2. The record is honest in both directions. Next week we grade the new rule the same way. The scoreboard. The S&P 500 closed at 7,411.98, down 0.61% on the week. The Nasdaq 100 tracker QQQ closed at 684.23, down 1.6%. The VIX finished at 18.58, down 0.19 points. The 10-year Treasury yield rose 14 basis points to 4.69%, and a basis point is 1/100th of 1%. So that is a real move in the cost of money. And breadth. 62.4% of S&P names above their 50-day average. Now the Overlord lens. Coming into the week, the options market priced a 2.58% weekly swing. The S&P moved 0.61%, barely a quarter of what was priced. So, the options market charged for a storm, and the week delivered a light breeze. And that gap between priced fear and delivered movement is exactly where disciplined sellers earn. The Overlord number of the week, QQQ IV Rank at 77, near the top of its 12-month range. Hold that thought, because it is the story of the week too. And on screen, the S&P against the VIX for the last 3 months. The regime map. 1 picture, 4 boxes. Where are we? This week, participation broad, index IV low to moderate. 62.4% of S&P names sit above their 50-day average. So the lifting is spread across more of the market than it was a week ago. But the IV rank split has not moved with it. QQQ at 77, SPY at 30, IWM at 25. IV Rank asks one question: where does today's option pricing sit inside its own past year? From 0 at the cheapest to 100 at the most expensive. Translation: more of the market is pulling its weight, and the options market still thinks the danger sits in technology. That is the regime, broader at the base, still charged at the top. The premium read where the market is actually charging for risk. QQQ IV Rank 7.7 near the top of its 12-month range. SPY at 30, the lower range. IWM at 25, lower still. The lens. QQQ's rank of 77 is the highest of the three by a wide margin. A rank near the top of its own 12-month range means the market is charging more for technology risk than it has for most of the past year. The meaning? The fatter premium on technology is not a bonus. It is the price tag on genuinely higher risk. That is not generosity, and it is not free money. It is the market's price for uncertainty. The income lesson this week: premium is the market pricing risk, not generosity. Read conditions, not tickers. And if you want to pressure test a stock you own against basic covered call criteria, the free covered call qualifier checklist is linked below. What actually mattered this week? The lead. AI spending doubts drove Thursday's sell-off. The Nasdaq fell 2.15% and the S&P 500 lost 1.21% on Thursday, as Alphabet's capital spending and Tesla's results revived questions about technology valuations. Monday opened cautious on Middle East tension ahead of the mega cap reports. Tuesday recovered on chip strength. Thursday undid all of it, and Friday closed the week roughly where it started. Rotation. Energy up 3.5%. Basic materials up 2.2%. Utilities up 1.7%. Consumer cyclical down 5.4%, and communication services down 5.8% brought up the rear. And those are the two lines where Tesla and Alphabet sit. Rates. The 10-year rose 14 basis points to 4.69%, and the 2-year rose 15 to 4.33%. So rising yields pressurized the index. The takeaway: yields rose 14 to 15 basis points, and WTI gained 8.27% as technology pressure pulled the major indexes lower. Energy up, technology down, and the rate backdrop leaning on both. Risk watch, and this is the slide that matters most this week. The VIX reads 18.58, low to moderate, but here the discipline line. A calm headline VIX is not low event risk, not with the FOMC, PCE and mega cap earnings ahead. Next week, the Federal Reserve's Rate Setting Committee, the FOMC, meets Tuesday and Wednesday, July 28 and 29. PCE inflation, the gauge the Fed watches most closely, follows Thursday morning, July 30. And the three largest reports of the season land inside 48 hours. Meta and Microsoft on Wednesday, July 29, carrying implied moves of 9.4% and 7.7%, and Amazon on Thursday, July 30, at 7.6%. An implied move is a swing the options market has already priced into that report. Those are event risk examples, not candidates. A calm-looking regime with a loaded calendar. That combination is exactly when discipline earns its keep. The Overlord Read. Broad breadth and technology premium stays elevated. The divergence breadth reached 62.4%, even as QQQ fell 1.6%, and QQQ IV Rank held at 7.7 against SPY at 30 and IWM at 25. Put simply, the market got broader and calmer while technology kept its risk premium, and those two things do not usually travel together. Why it matters? Participation broadened while options pricing kept the risk concentrated in technology. The premium is not spread across the market. It is still stacked on the names that move it. When the stock market broadens and the options market refuses to relax, listen to the options market. It is the one putting a rule price on being wrong. So here is the rule for next week. Set now, graded next Friday. Watch the VIX 20 as broad breadth meets the FOMC and mega cap earnings. Watch level, VIX 20. A break above 20 with breadth below 55 would signal renewed risk concentration. That is the line in the sand, and we will score it in public next week, held or broke, with the numbers. If this read helps you trade with more discipline, subscribe. Next Friday we will score this rule, rebuild the scoreboard, the regime map, and the Overlord Read. The free covered call qualifiers linked below. Thank you for watching. Stay disciplined. Let us go.